Welcome back, guys, to another video here at FiscalVoyage. My name is Felix, and in this video, Nick, a subscriber of this channel, he's a real great supporter of my channel. I appreciate you, Nick. He wanted me to do a stock analysis on Sun Communities Inc., ticker symbol SUI. And in this video, we're gonna do a stock analysis for you, Nick. Again, I appreciate you. Appreciate your support. And we're gonna do a stock analysis of this company to determine if it's a buy, hold, or sell. So let's get started. All right, the stock analysis for Sun Communications Inc., ticker symbol SUI. The company is a real estate investment trust or REIT that invests in manufactured housing, recreational vehicle communities. As of June 30, 2020, the company owned interest in 426 such communities in the United States and Canada, consisting of nearly 143,000 sites. I see Sun Communication kind of like a utility for residential communities, basically. So let's look at the fundamentals for this company. Revenue grew very nicely at 19.1% for the past 10 years. Net income from 2010 to 2011, they had negative net income returns, so I had to go from 2012 to 2019. But they grew net income in that 2012 to 2019 time period at a whopping rate of 60%. So the growth of this company has been tremendous, and we'll look closer in the fast graph later on in this presentation. S&P credit rating, they don't have a credit rating, but the balance sheet does look good. We'll go over that shortly. Operating income came in at 18.5% growth for the past 10 years, so that's very positive there. Free cash flow, since it's a real estate investment trust or REIT, we have to look at either funds from operation or free cash flow. So free cash flow for the past 10 years has grew at a decent rate of 4.5%. And for the past 5 years, revenue grew at 16.9%. So it is slowing down, but it's still a nice double-digit, high-teen growth for revenue. Net income for the past 5 years slowed down tremendously at a 1.1% rate. Free cash flow for the past 5 years grew at a better rate at 7.4%. So overall, the company is continuing to grow. So that's very positive. I like that. Let's continue with the fundamentals. For 2019, free cash flow per share came in at $4.41. Net margin increased to 12.7% for 2019 versus in 2018, the company had a net margin of 9.4%. So that's positive news there. I like companies where net margins are growing every year. It's positive there. Return on equity at 4.2% average over the past 5 years. So this has been consistent with their long-term look. 5-year dividend yield is at 2.84, where the current yield is at 2.15. So the current yield is much lower, is about 70 basis point lower than the 5-year average. So it might be an indicator that the company may be overvalued. Looking at dividend yield average, 5-year average versus the current yield is a good indicator for valuation. So it looks to be overvalued here, but we'll talk about that later in this presentation. 5-year dividend growth rate came in at 2.9%. The most recent increase was 5.3%, and 4 years ago they froze the dividend. They didn't pay out this. So there's been some years where they haven't paid out dividends, increased it. They've always paid it out, but there have been years where they haven't increased it. But overall, the 5-year average is at 2.9%. Dividend payout ratio currently at a nice rate of 71%. So the dividend is very well covered with free cash flow. So that's very positive. And earnings is expected to grow higher. We'll look at that in the next slide. Like I said, they've been growing dividends for the past 3 years. 4 years ago, they froze it. 5 years ago, they increased it. 6 years ago, they froze it. And we'll go over that in the fast graph. The charter rule came in at 5.1, so that's very low charter rule point scale. I like to see for REITs around 8 or 9 and higher. We just got here at 5.1, so that's something to consider. So look at the balance sheet. Like I said earlier, it's a pretty good balance sheet, even though they don't have a credit rating. Debt to cap at only 42%, so that's modest there. It's not too high, not low, but a decent debt to cap ratio at 42%. Current ratio, a nice ratio of 3.6. You like to see this at 1.5 or higher, preferably 2 and higher. So this is positive there. Debt to equity ratio at 0.8. I like to see this at about 1.2 and lower. So the lower than 1 or 1.2, very positive there. So this is a good debt to equity ratio. Interest coverage is decent at 2.1. I like to see this at 2.5 and higher, but decent interest coverage ratio. Price to book ratio at 3.3 versus a 5-year average of 3.1. Another indicator that it might be overvalued here, but overall it looks good, the price to book ratio. So look at the future outlook at this Sun Community stocks. 2020 are expected to come in free cash flow at 441, so basically flat with 2019. And for 2021, an increase to $5.12. So analysts are expecting a decent increase for 2021 and on. And actually, they're projecting about a 3 to 4% growth rate in free cash flow for the next 3 to 5 years. So that's positive there. So the company is growing. So that's very good news. The dividend dual return model, however, is projecting a 4.1% annual return. And this has to do a lot with the valuation. And we're going to talk about that shortly here in the fast graph, as well as my fair value slide. And the forward PE or P to free cash flow is at 28.6, much better than the current price to free cash flow of $33.04. However, it is much higher than the 5-year price to free cash flow average of 23.5. So this is a very good indicator that the company may be overvalued at current prices. So let's look at the fast graph and go more in detail in Sun Communities. All right, here's the fast graph for Sun Communities Inc., ticker symbol SUI. As you can see here, as of yesterday's closing price of $147.17, the company has been growing tremendously. If you're fortunate enough to buy this stock in 2009, 2010, you can see here you've been growing total annual rate of return of 18%. You've had a 5-bagger at a 500% total rate of return, outstanding. And the best part here, what I like, is that in 2008, 2009, the company was able to hold the dividend, and not only that, increase free cash flow. You can see here 2% growth in 2008 and 3% growth in 2009. So even though a lot of REITs and financial companies were cutting the dividends, earnings were decreasing, this company was able to not only grow free cash flow, but also continue to pay out a dividend. It froze, but they would continue to pay out dividends. They started increasing, as you can see here, in 2014 from 252 to 260. But overall, that right there shows tremendous resilience in this company. And since then, the company has been growing free cash flow at a decent rate, as you can see here. This year, they're expected to be flat versus 2019, you can see here. But still, overall, 2021 expected to be a 16% growth. But as you can see, it is very overvalued based on its historic valuation. The company or the market tends to value it at about a 16 free cash flow or price to adjusted funds from operation. You can see here currently it has about a 33 price to adjusted funds from operation versus the 16. So that's very high valuation. And not only do you have a high valuation, but as you saw, expected earnings are only expected to be growing about 3 to 4%. So for this high valuation, I would expect the company to be growing at about 20 to 25% annually, for the foreseeable future. But this high valuation is a very good indicator that the company is overvalued. You can see it here based on the fast graph. It looks to be overvalued, and as well as my other metrics that we just went over. And then in the next slide, we'll look at the fair value price slide and really determine what other analysts are expecting as a fair price. But overall, the company is growing, very solid free cash flow. You can see the dividend is well covered at 71% payout ratio versus the expected free cash flow earnings of $4.41. So overall, the company itself, very solid company, decent long-term debt to cap ratio. As you can see here, analyst scorecard is pretty accurate with estimating this company, so I'm very confident with these estimates. But overall, you can see that the company is overvalued. It went as high as you can see here, $164, and right now it's at $147. But don't just look at the price, look at the fundamentals. This is what I love about FastGraph, and I love doing my presentation because I look at fundamentals and then look at the price. But the company itself is a very solid company. I like it. But if you were fortunate enough to buy it in this time period from 2010 to 2012, good for you. You've done excellent investment here. But right now, I would looks to be like holding for this company. So let's go over the fair value price and determine if it's a buy, hold, or sell. All right, so here's the fair value price slide. CFRA is expecting a $96.49 fair price for this company, so it is overvalued at current price, and we'll look at that shortly. Morningstar expecting $125 as its fair price. FastGraph, as you just saw, around $115 or $120. Yahoo at $158, and my dividend discount model analysis at $82. What I used for this was a 5% dividend growth for the next 3 years and 5% after that with a discount rate of 9%. And even that, in my opinion, is very optimistic. I think personally a 3 to 2% dividend growth for the next 3 years plus with a discount rate of 9%. But I use a 5% because the most recent increase was 5%, but I think this is very optimistic. However, averaging out the 5, we get a fair price of $116.59. And currently, Sun Communities go for $146.19. Therefore, it is overvalued by 20% at current prices. With that, my recommendation for Sun Communities Inc. is a hold at current prices. So there you have it. Those are my thoughts of Sun Communities Inc. Again, ticker symbol SUI. I think this company itself is a very solid company. Revenue is growing, net income growing, free cash flow is growing. The dividend is very low, and that is because of the high valuation. It's inverse. When the price increases, the dividend decreases, depending if the company increases the dividend at a high substantial rate to keep up with its normal dividend yield. The 5-year average dividend yield is much higher than the current yield, another indicator that is overvalued. As you saw in the fast graph, it looks to be overvalued based on the fast graph, based on the price to fund free cash flow and versus the 5-year price to free cash flow. That's another good indicator that the company is overvalued. So that's why I have a hold recommendation for Sun Communities. But overall, solid company. I like it. Thank you, Nick, for suggesting this company. I added to my watch list. This is definitely a company I personally would like to own eventually because it is a solid company. Like I said, in 2008, 2009, they were able to grow the earnings, their free cash flow, and in this year, they haven't froze or cut the dividends, so that's very positive. So this overall, the company is very solid, just that I don't like the valuation at current prices. So thank you for watching. If you're new to the channel, make sure to hit that subscribe button. And if you enjoyed the video, hit that like button for the YouTube algorithm. Help grow my channel. And also check out my free ebook in the description below. 5 quick metrics to look for before you spend more time in evaluating any specific company. So thanks again, and I'll see you guys in the next one.